What's going on, y'all? It's Investor Zimp, aka Zimp Trades, and we back with another video. Today is an important one, okay? Probably the most important thing. Risk management, okay? This is the difference between gambling and Forex trading, okay? I see it all the time on the internet. Even when I tell people what I do sometimes, oh, Forex trading is gambling, day trading is a scam, it's gambling. No, it's because you're trading like a gambler. And today I'm going to pretty much explain how not to do that, right? The most important thing you need when you come into this market is a plan, okay? You're not doing jack without a trading plan, okay? So today we're going to walk through a trading plan, and I'm actually going to create a mock one for you guys so you guys can see exactly how to do it. Boom. Trading plan. Alright, first thing you need is an edge. The edge is simply your strategy that can be back tested. Alright, I'm going to link my strategy up above, but the point is there's plenty of strategies that you can use that are viable in this market. Back tested simply means that you can go back in time, right? I'm all the way in 2022, 2021. You could test your strategy all along these years, and it works more often than not. All right, you want to pick a strategy that works in the past, works now, and will work in the future. All right, for the best results. That's just the simple rule of thumb. If you hop in the market with no strategy and you're just buying and selling randomly, then you're gambling. All right. So next thing is risk management. The whole point of this video, right? So let's go ahead and make a mock trading plan with some numbers so that you guys can see exactly how to set it up for yourselves, right? We're gonna go ahead and use $10,000 as an example. Why 10,000? Man, I feel like the average person, if you really save up every penny you can in 1 year, you should be able to come up with $10,000. I think it's not too bad of a goal. All right, so $10,000, we're gonna use it. The first thing you want to figure out is your risk per trade. All right. So rule of thumb, I use 2%. All right. You really shouldn't go over 4. I don't really know any traders that risk more than 4% per trade, but I keep it at 2 just to be safe. All right. So if we do that math, 2% of $10,000 is $200 per trade, right? This means that at any point, if I'm in a trade and it goes $200 in the red, I have to close. If you don't close, you're gambling. All right, because you're not following your trading plan. You're gambling. All right. Next thing you want to figure out is your daily max. Now, daily max isn't too important as long as you're following your risk per trade, but it's just something I set for beginners to really, like, if you lose, let's say you lose $500 in a day, right? You lose $500 in a day, that's 5%. The reason I set a daily max is because people, when they take a lot of L's in a row, their natural instinct is to go ahead and revenge trade and get that money back. Once you lose 5%, that's a pretty big chunk of your account. You want to just put your phone down and take the L. Like as a trader that's been in this market for 4 or 5 years, listen to me, bro. Take the L. Just take the L for the day. Put your phone down and get back in on another day. Your emotions are not going to be where they are after taking those L's, especially if you're a beginner. Your emotions are not going to be where they're at. You might try to revenge trade. You might try to force a couple setups to try and get the money back. Just take the L, bro. Put your phone down and get back at it the next day. All right? So set a daily max, but the most important thing is the risk per trade. All right? Follow that risk per trade to the T. So now that we defined our risk parameters, we can talk about the next step in the trading plan, which is calculating your lot sizes. All right? So the first rule I'm going to teach you guys here is perfect for scalpers and not swing traders. This rule is perfect for scalpers and day traders. All right? Swing traders, I got something for y'all too, but for everybody that's really not trading too big stop losses, we call this the 40 pip rule. All right? And this rule states that every $200 in your account go up 0.1 in lot size. All right. So this means that on our $10,000 account, our max lot size would be 0.50. Now, if you take 0.50 lot size and you lose 40 pips, you just lost $200, which is our max risk per trade. This is why I call it the 40 pip rule, right? Because if you're a scalper or you're a day trader, 90% of the time, if you're trading on the 1 hour time frame or below, your stop loss is not going to be more than 40 pips 90% of the time, right? The other 10%, you might see a setup on the 4 hour or the daily where you say, okay, I might need 50 pips or 60 pips stop loss room so that you can catch a long setup, all right? And that's fine. That's when the second rule comes into play, all right? And that's called variable lot size. All right, and this just simply means you're going to be calculating your lot size for every trade. All right, so like I just mentioned, right, what happens if you have a 60 pip potential stop loss? Well, you can't use a 0.5 because that's $300 risk, and that's over our risk per trade. You can't use a 0.4 because that's $240 of risk. But what happens if you use a 0.3? Well, that's $180 of risk. So in this scenario, right, if you're taking a longer setup that has 60 pips of a potential stop loss, or maybe you had a bad entry and you still want to take the trade, you're going to have to get into 0.3 in order to adhere to your rule up here. Okay? That's just simply the way it is. If you're taking the higher your stop loss, the lower your lot size. All right? If you're taking 100 pips potential stop loss, you would have to drop it even further because you can't use a 0.3. That's going to give you $300 of risk. All right, so you would have to drop it even further to a 0.2, right, to be within your guidelines. Now, the 40 pip rule, the reason I really love it so much is because me personally, I don't like math. I like to just get in and worry about my analysis. And I just don't like doing all these calculations for every trade. So once you calculate your max lot, you can literally use that lot for every single trade without having to think about it. Unless the trade is over 40 pips. That's when you switch to this one. All right? So use this for every trade under 40 pips. Use this if you want to take a bigger trade that has more potential for a loss. All right? That's as simple as it gets. The next and the last thing we're going to talk about is risk to reward ratio. What is risk to reward ratio? This is the amount of risk versus the potential reward. So risk to reward is best illustrated on the chart. So we're going to go to the chart. I already have a setup drawn up, right? You get in right here, right where my mouse is. Stop loss is below the low. Take profit, key level of 197, okay? Even level. TradingView actually calculates the risk to reward for you. As you guys can see, it's a perfect 3. This means that our potential of profit is 3 times higher than our potential of loss, okay? So let's just say we're using a lot size that would give us a $50 risk, okay? Right, so let's just pretend that all of this loss down here, if you hit stop loss, if a trade goes down here, that's $50, okay? But your take profit, because it's 3 times higher, would be $150 reward. Okay, so you're risking basically $50 to make $150, right? Now that is considered a very, very good trade. Let me show you guys why this actually matters, right? Let's say you take 5 of these setups in a week. All like this, okay? Let's say you win 2, but you lose 3. You win twice, $150 times 2. That's $300. All right. But you lost 3 times, so 50 times 3 is minus 150. Even though you lost more than you win, you still walk away with $150. That's why risk versus reward is so important. Now, if you guys have a good strategy, like me, I only trade 2 to 3 times a week, right? I only place 2 to 3 trades a week. The potential that I lose 5 trades in a row is so I can't even remember the last time I lost 5 trades in a row. Like, to be honest, it's probably years ago. Like, if you have a good strategy, you guys are going to be winning a lot more than you're going to be losing. But even just in case, risk to reward, even just in case, if you happen to lose more than you win, let's say you have a bad month or something, right? If your risk to reward is straight, it doesn't even matter. You're still making money. That's why it's so important. Now, my rule of thumb, now guys, I will put this out there. A risk to reward ratio of 3, that's really, really pretty good. That's a really good average risk to reward. If you can get every single setup to have a risk to reward ratio of 3, then that's really, really good. But I'm going to be honest, that's not going to happen every single time. So my rule of thumb is I like to keep all of my trades over 2 risk to reward. Alright? If it's under 2, I won't really take it unless it's extremely good looking. But I like to keep all of my trades over 2 risk to reward. Just in case, if I lose 5 out of 10 trades, I'm still making money that way. Because what I'm making is always going to be 2 times than whatever I'm losing. So for every 2 losses, 1 win can make it up. That's why, guys, when I lose in the market, when I lose in the market, because it's inevitable, right? When I lose my trades, I don't really care too much. Like, I will literally just be like, okay. Because I know whenever I win, it's going to be 2 times more than what I just lost. So that's why I have this rule of thumb. Now, I know some traders, I have a friend that trades as well. He only takes setups that are over 3. So he don't play around. You know what I'm saying? And I know some scalpers that will only take a setup that's, 1.3 or 1.5 over. It's weird because they trade a lot. But if you guys keep a rule of thumb, your risk to reward should always be positive, right? You never want to get to a point where you're risking more than you could potentially make, right? Let's just go look at another setup real quick for another example. Like, even right here, right? I'm going to redraw this. Even right here. Let's say you're looking for a sell because of the structure, right? And you see it start to sell right here, but oh shit, you get in late. All right, let's say you get in late on a short position right here. You're gonna have to put your stop loss above the high, and let's say your take profit, put it at 195 because that's the next key level. As you guys can see, your risk to reward goes down to 1.65 because your stop loss is now bigger because you decided to enter late, right? So it doesn't mean the trade is a bad trade because, as you guys can see, it still went and hit take profit. But because you entered in late, you weren't able to get, you had to risk more to get into the trade, right? Now, you could decrease your stop loss, but that wouldn't really be a smart idea based on the structure of the trade. So it's just a lot to think about. You know what I'm saying? When you're trading, it's just another thing to think about. The better your entries and the better you can time them. For example, if you were to got in right here, right? If you were to get in all the way up here where it started at, and you only had to risk this much, look at your risk to reward now. 4.75. It's much, much better that way. You feel me? So those are just some examples, guys, but really, rule of thumb, all of your trades over 2 risk to reward. 3 if you're really ambitious. 1.5 if you take a whole bunch of trades. But honestly, anything over, 1.5 is all right. As long as you're not losing like 10 trades in a week in a row, you'll be all right. All right. So that's pretty much the gist of the trading plan. You want to have, strategy. Okay, are you a scalper? Are you a day trader? Are you a swinger? Risk management. Make sure you do your math. Figure out how much you can afford to risk per trade and don't go over that. Then your lot sizes. If you're under 40 pips, use this rule. If you're over 40 pips, stop loss, use this rule. All right. And then make sure your risk to reward ratio, make sure you type it out. You only look for setups over 2, over 1.5, over 3, whatever it is, whatever you feel comfortable that you can find setups with, use that. And that's that, guys. That's trading plan. That's a simple trading plan. Create it, print it out, follow it. Whenever you are not following this plan, you are gambling. Simp out.